Welcome, ladies and gentlemen, to the Cima SCS P3 or Risk Management Complete Essentials Revision segment number 4. So, this is a very important segment, something that is inherently embedded throughout all the strategic case study papers. You know what it is: reputational risk. Let's take a look. A quick reminder on a few kind suggestions: do have a notebook and pen on the ready. Follow the slides and my explanation carefully. Make notes as you deem necessary, and do maintain a list of key topics that you feel you are weak at, so you can self-revise later, maybe even in detail. And maintain a list of key performance and management tools that can help model answers in the strategic case study exam. Quick reminder on the co-activities. As you know, this relates to co-activity D and E. Specifically, reputation risk relates to co-activity D, evaluating and mitigating risk. There is a sub-element with respect to maintaining sound control also, because you have the controls in place to ensure that nothing happens or nothing goes wrong that will lead you to reputational risk exposure. All right. First, we have to understand what reputation and reputational risk means. Reputation is defined as the belief or the opinions that are generally held about someone or something. And what exactly is reputational risk? Reputational risk is therefore the likelihood of losses occurring due to a deterioration in the belief or opinion held about someone or something. So, everyone or everything has a reputation attached or associated, and the risk element comes in if that reputation, the intact or the nature or the level or the extent of that reputation, if it is in danger of getting damaged, there you have reputational risk. So what exactly or how important or why is reputational risk important? Reputation is an area that organizations are increasing their focus upon, partially because there have been some high-profile instances of reputational damage in recent times, and partially because of the rise in social media giving more customers a bigger voice. Reputational damage can be caused by many factors like dishonesty, incompetence, activities that do unnecessary harm to the environment, or unethical behavior. It can be caused by an individual or by the behavior of a company as a whole. Right. Next, we look at the sources of reputational risk. Where can reputation risk arise from? These the sources are of diverse nature. The sources of reputational risk are many and very diverse. It could manifest itself in anything from accounting deficiencies, poor customer service, lack of IT security, or failure to meet expected standards of quality. All of these could lead to media coverage, resulting in negative perceptions of the brand and the company. These negative perceptions can then lead to investors and customers going elsewhere. Another very important aspect is the social and environmental consideration. There are two key areas to consider from PESTEL, which are social and environmental. Some factors are obvious. It would be detrimental to a firm's reputation to encourage an unhealthy lifestyle, endorse violence, be involved with forced labor, or knowingly damage areas of outstanding natural beauty or of significant historical interest. All of which I can tell you are currently going on in certain regions of the world. However, most social and environmental considerations are more complex than some of these examples, but to be really honest, from the lowest level, from the most ground level to the most complicated levels, social and environmental considerations have become a very relevant aspect that is currently, I personally see as a major risk that Mother Earth is facing. All right, moving on. Another key source is the business ethics side of things. Ethics is a set of moral principles that guide behavior based on what is felt to be right. It normally comprises principles and standards that govern business behavior. You know what ethics are, and we talk about ethics at great length in E3. But see, one thing that I want to mention as we go along, a quick word, is that you will notice that P3 very closely relates to E3 and F3. And because in E3 and F3 we look at the continuity of things, and in P3 we look at everything that we looked at in terms of ecosystem, in terms of strategy, in terms of financial strategy. We look at the risk exposure of all those elements. So that's why it's almost like a mirror image. P3 is a mirror image of E3 and F3, in the sense that E3 and F3 we learn about them. In P3 we look at the risk aspect of those. So that's why you see that close connection as you do with respect to ethics. So actions can be judged to be right or wrong, ethical or unethical, by individuals inside or outside the organization. Apart from any moral duty to be ethical, the prime purpose of a business is to maximize shareholder wealth, and the chance of this happening is increased by the adoption of ethical behavior. Then you have the corporate social responsibility, the CSR aspect. So CSR refers to the idea that a company should be sensitive to the needs of all stakeholders in its business operations and not just shareholders. As such, ethics is just one dimension of corporate social responsibility. By aligning the company's core values with the values of society, the company can improve its reputation and ensure it has a long-term future. It is important for the organization to have some clear goals in mind with regard to its CSR strategy. True. Considering the things that get measured gets done more often than things that are not measured. Especially, the company should measure the result of any CSR program using appropriate metrics. So let's take a closer look at the ethics side of things. Now, when it comes to reputational risk, even you know, as Cima, potential Cima, aspiring Cima members, and currently Cima graduates, you know that there is a code of ethics that Cima relentlessly pursues. So similarly, we look at what, as chartered management accountants, the level of understanding we should have. A duty exists to observe the highest standards of conduct and integrity, and to uphold the good standing and reputation of the profession. They must also refrain from any conduct which might discredit the profession. Now, the institute promotes the highest ethical and business standards and encourages its members to be good and responsible professionals. Good ethical behavior may be above that required by the law. Members must avoid actions or situations which are inconsistent with their professional obligations. They should also be guided not merely by the terms but by the spirit of this code. So Cima members should conduct themselves with courtesy and consideration towards all with whom they have a professional dealing with, and should not behave in a manner which could be considered offensive or discriminatory. All very relevant to all of us. So Cima's code of ethics is just a snapshot. As you know, there are 5 fundamental ethical principles. What are these? Integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. So integrity means that members should be straightforward and honest in all professional and business relationships. So I would say integrity is one of the most important ethical principles that we have to uphold. Then objectivity. Members should not allow bias or conflict of interest in business judgments. Then you have professional competence and due care. Why we are learning all of these things is because the Cima examiner absolutely hates and detests promoting anyone they deem incompetent. So this is the duty to maintain professional knowledge and skill at the appropriate level. Then you have confidentiality, which is the information on clients that shouldn't be disclosed without appropriate specific authority. Professional behavior is that members must comply with relevant laws and avoid actions discrediting the profession. So overall, it's very important to keep an eye on whether there is any kind of breach of the code of ethics. Now, Cima, as you can see, the link is provided. You can check it out as well. Cima published this in a large document, which you can easily download also. And here you basically have part 1, part 2 and part 3. So the part 1 involves these, the fundamental ethical principles, as you can see, complying with the code, fundamental principles and conceptual framework. That is the heading of this part. Complying with the code, 110 is fundamental principles, these 5 and 120 is the conceptual framework. You can check it out. Then, however, there are 2 additional parts in the code of ethics. So the second one is for professional accountants in business, including chartered global management accountant designation holders. That is when the AICPA partnered with Cima. So here you look at things like applying the framework, ethical conflicts, conflicts of interest, include inducements including gifts and hospitality, preparing and reporting of information, educational services, general standards in terms of competence, acts discreditable, professional behavior, confidentiality, the details are provided, pressure to breach the rules and fundamental principles, responding to non-compliance with laws and regulations. For Cima only, not CGMA. Then you have part 3 for professional accountants in public practice. So as you can see, Cima has taken a lot of trouble to go into the level of detail that many practicing accountants, management accountants need, and I think it's a really commendable effort on the part of Cima, try and elevate the importance of the code of ethics. So that is just a snapshot of what I wanted to make was to make it a point to explain to you or to show you that Cima takes this very, very seriously, and they commit a large amount of resources into this. All right. So coming back to the core discussion, let's take a look at ethical threat types. There are a few. Number 1 is the self-interest threat. This may occur due to personal financial interest in a situation that could create conflict. The self-review threat may occur when previous judgment needs to be re-evaluated by the member responsible for that judgment. And this is why we try to keep internal audit independent. The advocacy threat may occur when a member promotes a position or opinion to the point that subsequent objectivity may be compromised because you feel so attached to that opinion. It could be your opinion, it could be someone you admire, someone you consider a mentor or a coach, and you might be prejudiced. This could lead to advocacy threat. The familiarity or trust threat, which may occur when, because of a close or personal relationship, a member becomes too sympathetic to the interest of others. I think, to be really honest, I think I'm a little personally exposed to the familiarity or trust threat, not to the level that it breaches any types of ethics. I think in my case, it's a matter of my commitment to the familiarity and the trust element to the level that I want to uphold the ethics of personal relationships to the best possible level, but you always have to find the right balance, which in my corporate career I can happily say that I have. The intimidation threat may occur when a member may be deterred from acting objectively by threats, whether real or perceived. Then you have the adverse interest threat, which may occur when a member does not act with integrity because their interests are opposed to the employer. So fundamentally, I think one of the examples that I can tell you is in my corporate career, there was one incident, one company that I decided not to continue to engage with. There are clients I have decided in my consultation work, I have decided not to engage with because of this threat, because of the adverse interest threat, primarily because of the value, the ethical values completely not being in line and different, fundamentally opposite. Anyway, If identified threats are other than clearly insignificant, a management accountant should apply safeguards to eliminate the threats or reduce them to an acceptable level, such that compliance with the fundamental principles is not compromised. At any point, we cannot let the fundamental principles be compromised. Note that the ethical threat does not necessarily have to relate to personal ethics, but could focus on a business decision and its possible implications. That's an important point of note, because you have to understand that these are all correlated and these could come back in the long term or in the medium term. So that understanding is very important to continue moving forward. That leads us to ethical dilemmas. Now, what is an ethical dilemma? Dilemma will only occur if there are two or more interests at stake, even if it is only an ethical duty to oneself. And this exists when one or more principles of the code are threatened. Now, for example, right, you may have discovered something unethical, illegal, or fraudulent going on where you work. Or perhaps you feel that you have been asked to do something that compromises your professional integrity. So these are variants, these are strategic case study variant incidents that you must keep an eye on. That's why I always stress in the case study to never miss out any ethical concerns that you note. Now, when this kind of situation is there, conflicts of interest and confidentiality issues are also ethical problems. In general, ethical issues should be dealt with taking actions called safeguards to reduce them to a level where they are no longer significant or of any consequence. So, with that understanding of the kind of ethical conflicts and ethical dilemmas, let's look at ethical conflict resolution. So, as you can see in this image, the sequence of steps that you can undertake to resolve an ethical conflict is to check the facts, escalate internally, escalate externally, and then finally refuse to remain associated with that conflict. While you do all of this, while you go through the 4 steps, it's very important to document anything, communications, all of that, to document the issue, and to also seek professional or legal advice when possible. Recommendations by Cima for addressing situations for ethical conflict: gather all the facts and relevant information, ascertain the ethical issues involved, and identify the fundamental principles related to the matter in the question. Escalate the concern internally, that is to the direct management. You can, your supervisor, someone trustworthy, maybe HR. You can escalate the issue further to your manager's boss, the board, or a non-executive director, following any internal grievance or whistleblowing procedure if you have them. You can also seek advice from Cima. Report externally to auditors or relevant trade or regulatory body. Remove yourself from the situation and document the steps you take and keep copies of relevant correspondence. These are all very smart recommendations that you can easily bring in if ever the question arises in the case study with respect to dealing with an ethical conflict. Conflicts within your own organization. There may be times when an accountant's responsibilities to an employing organization and their professional organizations to comply with the principles, the fundamental ethical principles, are in conflict. Then what do you do? Pressures. Right? First, let's take a look at the pressures that may be faced. A professional accountant may be put under pressure by managers, directors, or other individuals to act contrary to law or regulation, to act contrary to technical or professional standards, facilitate unethical or illegal earnings management strategy, lie to, or otherwise intentionally mislead, including misleading by remaining silent, others. In particular, the auditors of the employing organization, any regulators, any monitors that come in. And issue or otherwise be associated with a financial or non-financial report that materially misrepresents the facts, including statements in connection with, for example, the financial statements, tax documents, legal compliance, any reports required by securities regulators, right? You Really shouldn't be messing around with those. Now, in such situations, what are the safeguards you can apply? The significance of the threats arising from such pressures, especially like intimidation threats, you must be evaluating them. And if they are other than clearly insignificant, safeguards should be considered and applied as necessary to eliminate them or reduce them to an acceptable level. You can also consider obtaining advice where appropriate from within the employing organization or an independent professional advisor or a relevant professional body. You can also utilize the formal dispute resolution process within the company. You can check it out. Most of the time, either HR or even in your offer letter, there might be links to checking it. The formal dispute resolution process, and you can seek legal advice. And those are the ways that you can deal with conflicts within your company. Next, we move to a slightly different topic: brand versus reputation. We need to understand the difference between brand and reputation before we associate strategy to these two. There is a difference. In fact, they are often used as if they are the same thing, but they are not. Now, the brand is something that the organization can control to a certain extent. So you have a certain amount of control. It's about what the organization does and how it approaches its products, services, and interactions. So that's why you call it brand management and not reputation management, because you can control it to a certain degree. Reputation is what people think about an organization and, crucially, what they communicate about an organization. This is much harder to control. Doing the things that the brand sets out is a good way to go about building a reputation, but there is no guarantee to it, especially in the day of social media. Now, it's important that the board recognizes that managing the brand and reputation is difficult. It is much more than a public relations exercise or a marketing exercise. Without delivering on the promise, they are just words, which eventually people stop believing. Remember the trustworthy factor? There we go. Impact of strategy on brand and reputation. So, how does strategy help? Now, if you have the right strategy that links to conveying the right brand image to achieve success in the marketplace the organization has chosen, is fundamentally the best way to link strategy to brand and reputation. Now, this involves developing strategies to ensure that the organization has the right resources available and the right people in place with the time they need to do the job well and to deliver on their brand and their strategic promise to achieve a good reputation. So, actually, one example I can tell you is there are clients I know who have undertaken government projects by over-promising. And what happens when you over-promise is that you under-deliver. And when you under-deliver, your reputation starts facing serious questions and falling ultimately. Like most risks, it requires the entire organization to work together, which is why the strategy chosen and the message the board conveys to the rest of the organization is so important. Because that collective effort and the collective consciousness about the reputation has to be there. That brings me to strategic alignment, where alignments should start at the very top of the company, and it's about the board making sure that the strategic goals, the company culture, and the processes align for the reason the organization exists, and which is basically achieving the mission and the vision and the objectives. Now, if the board gets this right, then the organization has the best chance of enabling the reputation to match the brand they promise. True, if they get it right. So you can see so many examples when the strategic alignment of whatever they come up with, whatever they do, whatever their objectives are, whatever the way they try to achieve those objectives, whatever their financial goals are, whatever their culture is, how they establish their processes, when these are not aligned, right, when they are not in line with each other, when they don't parallelly move in tandem together toward one direction, then this final idea of enabling reputation to match the brand doesn't get delivered. The whole thing is, you say something, do it better if you can do it better. To give you a view on the full slide, there we go. Now, you know that in the divisional structure of things, transfer pricing is a key aspect, because divisions, SBUs, they might be in the same jurisdiction, they might be cross-country, multinational, then one company is selling to another. In all these cases, you have transfer pricing, and transfer pricing can be a source of reputational risk. See how? One aspect is the government action and the government scrutiny on transfer pricing. Governments are aware of the effect of transfer pricing on profits. In many countries, multinationals are required to justify the transfer prices that they charge, because you know, you can reduce the international tax liability if you play it right. Multinationals could be required to apply arm's length prices to transfer prices. In other words, they might be required under tax law to use market-based transfer prices and to remove the opportunities for tax avoidance. It is also possible, on the other hand, that some countries wishing to attract business might have tax laws that are very favorable to business. A country with, you know the term, tax haven, what do the countries offer? A low rate of tax, obviously, a low withholding tax on dividends paid to foreign holding companies, tax treaties with other countries, and no exchange controls. They usually have a stable economy, good communications with the rest of the world, and a well-developed legal framework within which the company's rights are protected, which is why almost all large conglomerates you find in the world have established their financials and treasuries in certain cases within tax haven jurisdictions, because of all these benefits you can get. In fact, Trump's reduction of tax saw the largest amount of money coming back home, because almost all this money of the US based entities, until Trump repealed, or rather reduced, the corporate tax rate 10%, if I'm right, from 15, was parked. All that money was parked in tax havens. So the government scrutiny is one aspect, and on the other hand, you know that transfer pricing can be used to manage cash flows. So what happens is that governments might place legal restrictions on dividend payments by companies to foreign parent companies. In this situation, it would be very tempting for a multinational to sell goods or services to a subsidiary in the country concerned from other divisions in other countries and charge very high transfer prices as a means of getting cash out of the country. So it's purely a recorded sale where you bill from one country because you want to get some money to a particular country, maybe country X. So what happens is you make it look as if the subsidiary in country X is selling. When they sell goods to a subsidiary in country Y, that subsidiary has to pay that money. It looks like a transaction using transfer pricing, but no, it's basically moving money out. Because of this, there are regulations. This tactic is not possible when the country's tax laws require that transfer prices should be set on an arm's length basis. So, because governments know this, they have taken every measure to limit this. Not every government, but most of the developed ones. That brings me to fraud risk, a little bit of a closer look at fraud risk. Fraud can be defined as dishonestly obtaining an advantage, avoiding an obligation, or causing a loss to another party. If a fraud becomes public knowledge, it can affect a company's reputation. And the control systems within the company will be considered weak, which on top of all things can worry investors, and the share price can fall dependent on the size of the fraud and the investor's opinion of it. Future investors will be wary, and it could prevent the company from raising future finance, and even credit ratings can go down. Hiding fraud is unethical, and often in such cases the press finds out, and the consequences are far worse than they would have been if the company had come clean in the first place. So this is actually an area that gets tried and tested in the case study, where you're put in a situation, there is some sort of fraudulent behavior involved. What are you going to do at that moment? What are you going to do? It could be a superior, it could be a subordinate, it could be you. You're supposed to make a decision. What are you going to do? Stick to the fundamental ethical principles. That would be the best solution there. Then you look at bribery. Bribery occurs when someone in a position of trust receives a benefit as a reward for voluntarily acting in breach of that trust. Getting a reward for breaching that. The benefit can take many forms, including but not limited to cash, luxurious gifts, or favors to the individual. Now, if an organization is found to have been involved in bribery, then as with fraud, it can lead to negative connotations. Basically, negative perceived reputation risk. Now, in a Harvard Business Review article, George Serafine stated that bribery's most significant impact is its negative effect on employee morale, highlighting that reputational risk can lead to issues other than just reduced sales and declining share price. In the same way that a good reputation can attract employees, reputational damage can lead to a loss of skilled workers. They can actually jump ship. Then we arrive at the management of reputational risks. So we've looked at all these different ways that we can get exposed to reputational risk. How do we manage? There are many ways. Here are some examples. Good governance, employee relationships, environmental awareness, external relationships, risk professionals, having a sound policy framework, risk sensing tools. And a good reputation has many benefits, from attracting high caliber employees to attracting loyal customers. This can then lead to higher sales, both from these satisfied customers and from new customers attracted as a result of referrals. So, you can maintain a positive image like the one that we were talking about. It can then lead to easier access to finance and a share price that outperforms the market. Finally, a good reputation can help build relationships with legislators and regulators, which could mean being meaningfully involved in discussions around changes in regulations. So the idea is you maintain good relationships, you keep a track of all these many ways that you can use, that you have at your disposal to manage reputational risk, and therefore through that you could be involved in discussions and you could be an influencer because you are trustworthy. You could be a leader in various matters that relate to, especially in terms of the external matters, the non-controllable matters we were talking about. The better your reputation is, the more credible your word is, and the more influence you can exert, and because you will be allowed to exert influence because they trust you. They know that you're not an unethical person, and therefore you wouldn't come and suggest anything that is detrimental to the country, to the society, to the city, to the village. Then they tend to trust you. If your reputation is not intact, people don't trust you. This kind of power cannot be wielded. You can also look at it as a crisis response situation, the reactive aspect of things. Prevention is an excellent approach, but the reality is, as with every risk, complete prevention is unrealistic. So it is also sensible for an organization to have a crisis a response plan for an event that may damage their reputation. What are these further options you can have? You can have a crisis response team, a team of people who are responsible for coordinating a company-wide response will help make sure the message is consistent with the overall strategy, brand, and culture of the firm. You can also use scenario planning, especially if you have a risk committee or potentially the crisis response team, if you have one, can model various reputational issues and potential events, plan a coordinated and considered response to such events, rather than having a reactive response that could lead to further issues. And so, one, you have the proactive aspect of things, then you have the crisis response or the reactive approach of how you can manage reputational risk. And that marks the end of this segment, where you have a quick revision snapshot. We looked at many aspects. We understood reputational risk at depth. Nothing has been missed out. We first started by looking at what exactly reputational risk means. What are the sources of reputational risk? Fundamentally, there were 4. Then we started to deep dive into ethics. Right? What is the code? What are the dilemmas and the conflict aspect of things? Especially not only at the individual level, but also at the organizational level. And on the other end, we looked at transfer pricing as a source of reputational risk, the various angles that governments and countries and companies look at transfer pricing, other aspects like fraud and bribery. Then you looked at strategy and its very close link to brand and reputation, while also understanding that brand and reputation are different. And finally, how can we manage reputational risk? On that note, keep learning and do enjoy the process. That marks the end to this particular segment that we learned on reputational risk. So thank you all for tuning in. I hope the video and the segment has been very knowledgeable, very informative. Keep learning, happy learning, and all the very best. See you soon. Thank you.